Internal Revenue Service IRS Tax News. Tax Court strikes down 4 more abusive syndicated conservation easement transaction. IRS calls on taxpayers to accept settlement offers in syndicated conservation easement cases. IR 2020-152, July 13th, 2020, Washington. On July 9th, the U.S. Tax Court struck down 4 more abusive syndicated conservation easement transactions. The Internal Revenue Service calls on any taxpayer involved in syndicated conservation easement transactions who receives a settlement offer from the agency to accept it soon. These time-limited settlement offers, announced June 25th, there's a link to that here, are only being made to certain taxpayers with pending docketed tax court cases involving this type of abusive transaction. These and other recent tax court decisions support the abusive nature of the underlying syndicated conservation easement deduction. The 4 most recent U.S. tax court decisions disallowed conservation easement deductions totaling nearly $21 million. So they're basically saying, if you have a settlement for this, you might want to settle it now because they're pushing forward on taking action against these types of transactions, and it looks like the wind is going in their favor in terms of the validity of those cases, and therefore the settlement may be looking better and better, may be the wise choice if it applies to you. Quote, the IRS will continue actively identify, audit, and litigate these syndicated conservation easement deals as part of its vigorous and relentless effort to combat abusive transactions, end quote, said IRS Commissioner Chuck Reddick. Quote, these abusive transactions undermine the public's trust in private land conservation and defraud the government of revenue. We strongly recommend that participants seek the advice of competent, independent advisors. Ending these abusive schemes remains a top priority for the IRS, end quote. So obviously, if you are involved in this, or you have some questionable transactions, or if you get a letter from the IRS with an offer or something like that involving these types of transactions, then you want to talk to someone at that point and get some advice in terms of what the next steps would be to go into place on it. And you want to mention, obviously, bring up the fact that the IRS is stressing these types of cases and moving forward on taking action related to them, and there might be some more stringent regulations related to them. So you want to do some research and make sure you have advice going forward with them. So back to the text. The IRS recognizes the important role of legitimate conservation easement deductions in incentivizing land preservation for future generations. However, abusive syndicated conservation easement transactions have been of concern to the IRS for several years. So if you're in a legitimate type of transaction, that's of course one of the question you want to take a look at. You want to make sure that everything is legitimate on the transactions that you're taking place. You want to get some advice on that and make sure that everything's going forward the way it should. If you think that something isn't in a legitimate standpoint as of this time, then of course you want to get advice in terms of how to move forward from that point as well. Back to the text. The IRS is aware that some promoters of these abusive transactions have downplayed the significance of the string of recent court decisions holding in the government's favor, arguing that their case are somehow different, or that those decisions might be reversed on appeal. So note, this is something that there's been some question as to the deductibility of it, and possibly in people that are pushing these kind of transactions may then say that, hey, look, this is a legal transaction. It's just one of those loopholes. But in recent time, there's been more cases in it, which would solidify the IRS's position as they move forward with it. So it looks like going forward, it looks like the IRS is basically winning the case. That's, of course, what they're saying here in terms of the IRS pushing forward and having more leverage with these types of cases. So it's more likely that, if a transaction is not legitimate, that the IRS's stance will hold on it. And if you did invest in something and you didn't have complete awareness about it or about the legitimacy of it, again, you want to get tax advice on it and see whether or not it is legitimate. And if it's not, then or if you have questions about it in terms of these recent court cases, then you want to think about and get advice on how to proceed from there. So these promoters ignore common sense and argue that the real dispute is about value, neglecting to explain how the reporting of short-term appreciation, often exceeding many multiples of reality, could possibly withstand judicial scrutiny. So basically they're saying there's distortions in the estimates that are taking place here, which if any reasonable person, it looks like the argument is, if any reasonable person was to look at it, there's a clear distortion that's going to be happening there, and you would think that would not hold up in a court. So back to the text, quote, taxpayers should ignore this nonsense, take an objective look at their cases, and cut their losses, end quote, said IRS Chief Counsel Mike Desmond. Quote, abusive transactions like settlement offers do not get better with time, and this is a good opportunity to get out, end quote. So they're basically saying, hey, look, we know this. I mean, this is my interpretation of it. Hey, look, we know this is something that promoters have been doing. We think it's an abusive policy that's been taking place. Some people may have invested in them without being completely aware of it. You know, they might have gone along with it. So at this point in time, they're making you aware. And so if they have an offer at this point in time to remove yourself from that type of transaction, then it might be the time to do that, because it might be the best offer that you would have. It'd be an easy way easy way to get out before any kind of further type of action, which could be more severe, would take place at a later point in time. So back to the text. Enlisted syndicated conservation easement structures, promoters syndicate ownership interest in real property through partners using promotional materials to suggest that prospective investors may be entitled to a share of conservation easement contribution deduction that equals or exceeds 2 or 1/2 times the investment amount. The promoters obtain an appraisal that greatly inflates the value of the conservation easement based on fictional or unrealistic highest and best use of the property before it was encumbered with the easement. So they're basically, taking a deduction higher than the investment, which seems funny, right, in and of itself. How are they doing that? It looks, they could be making a projection, an estimate on the value, using the highest use of the land before there was an easement on it. So obviously the value is not, no reasonable person would believe that the estimate of the value of the land would be that high, and therefore that, that's a wrong estimate. So that's not going to hold up, you would think. If that's the case, then obviously that shouldn't hold up. You would think that estimate would be disputed pretty easily if it went to court, if there was an audit about that type of thing. And that's what the IRS is basically saying here. So back to the text. After the investors invest in the partnership donates a conservation easement to a land trust. Investors in the partnership then claim a deduction based on the inflated value, right? So now they got this huge deduction based on this inflated value of the property that was totally overvalued, is what they're saying here, and therefore the deduction is not at all valid, given the fact that it was an abusive appraisal on the value of the property. So back to the text, the investors typically claim a charitable contribution deduction that grossly multiply their actual investment in the transaction and defy common sense. So they're basically saying, and it looks pretty clear that if this was the case, then it would, defy common sense in terms of the deduction, and then you would think that the IRS, again, upon audit, would not have a whole lot of difficulty, making that case and winning, that case. And therefore, if you fall into that situation in this basically scenario, then you might want to look to see if you could take any kind of settlement or get advice on how to proceed further with that now, because the IRS is pursuing these items.